Hello, friends and family. Welcome back to Dividend Compounders with Cheese. Today, we are going to be looking at Nasdaq, ticker symbol NDAQ, and we are going to look at the intangibles, the finances, and run some valuation models to determine if I had $500, would I buy Nasdaq? So let's take a look at its dividends, because this is a channel that appreciates dividends after all. So right now, the current dividend yield is sitting at a very healthy 1.81%, meaning for every share of NASDAQ that you own, you get paid 88 cents annually. And the payout ratio is really healthy. It's below 50%, sitting at 39.46%. By the way, most people, they don't even know that NASDAQ has a stock. That's why we're going to be talking about it, because I truly believe that NASDAQ does not have the attention that it deserves. And if we look at the 52-week low, $46.88, right now it's trading at about that range. It used to trade at its high of about $69. So what happened? Why is it trading so low? And is it a value company? So what exactly is NASDAQ? It's a tech company associated commonly with the QQQ index and the Nasdaq stock market exchange, as you can see right here, Nasdaq. But its main bread and butter is actually data analytics, software, and services for all things related to the stock market. And as of recently, they just diversified their portfolio by buying a software startup called Verafin, which offers technology to detect and to protect financial security for its clients. And then they just got approval to buy out Adenza, to add a fintech arm to their business. So they are making very strategic acquisitions to diversify what they do. If you don't know, well, now you know. NASDAQ is one of those underrated cash flow generating companies that people are just not talking about. It's not on their radar. And they have a huge moat in its very nature, right? You can't just spring up a stock market exchange overnight. If you think about it, throughout the decades, NASDAQ has developed the relationships and laid the foundation to be one of the primary stock market exchanges of the world, founded in 1971. With that said, let's jump on over to the historical PE ratio to take a look at whether or not the valuation today is in line with what it was in the past. So currently it's trading at about a 21 PE ratio, which is about the same as the VTI stock index or what the S&P 500 is trading at. But if we are to zoom back out to the year after the Great Recession, it did trade at about a 16 PE ratio. And then when the recovery started happening, they hit single digits. Not very good. And then let's fast forward over here. And then when we jump on over to 2016, the PE ratio did jump on over to 95. By the way, NASDAQ did go through a recent stock split. So last year, NASDAQ gave a 3-for-1 stock split because the share price was a little too high and they wanted to make it a little more friendly. So let's take a look at what happened leading up to the pandemic. So it looks like it was trading at about a 27 to roughly about a 29 PE ratio. And then when the pandemic hit, stayed consistent. It stayed in the 20s. So I think when you consider the past 5 years, I think that NASDAQ is trading at a lower valuation. But remember, past performance is not indicative of future gains. Because if you look at 2019, it's about a 26 PE ratio. Now it's sitting at about a 21.8. The next thing that we are going to do is take a look at the past 5 years of how many shares are outstanding. Essentially, we want to find out if the company is issuing more stocks and diluting the shareholders, or are they buying back shares? Buying back is a good thing because less shares outstanding means that each share that you own has quality over quantity. So let's take a look at what's going on here. So back in, I know I said 5 years, but it looks like this graph is going to be a little more thorough. So back in 2009, it looks like there were over 644 million shares outstanding. And then if you follow along as the years progressed, it looks like Nasdaq very aggressively started buying back shares, which is a wonderful thing that you want to see. So it looks like they bought back about 250 million shares in the past 13 years, which is amazing to see. Next, we are going to be looking at the free cash flow and look at the trend. This is important because what you want to see for the free cash flow is an upward trend or at least a consistent free cash flow. And do you remember when I said that NASDAQ is a cash flow generating machine? Well, take a look at this. Back in 2013, this was their free cash flow, right? $459 million. And every year, they've been progressing steadily and slowly. And then obviously the pandemic, there was a hit. But then they were right back on track. And then right here, the decrease is probably explained by the two recent acquisitions. And then last year, look at the free cash flow. Over $1.5 billion compared to 2013 of $459 million. So that's 300% increase since 2013. This is a free cash flow generating machine. Next, we are going to be looking at the most recent earnings report investors presentation. Do you remember when I said that NASDAQ has an absolute economic moat? Basically, an economic moat is a unique product or service that the business has that gives them a competitive advantage that prevents or makes it difficult for other people to come onto their territory. So basically, a high barrier to entry for their specialized service or product. So the too long didn't read is that NASDAQ did beat their earnings estimates. So how exactly does NASDAQ generate revenue? Well, this is the main thing that people associate them with, right? The NASDAQ 100 or the QQQ index. However, this is their diversified portfolio and how they generate revenue from different streams. So the first one is their anti-financial crime pillar. Next is their marketplace technology segment, and then the workflow and insights. And then, of course, what they're known for is the NASDAQ index and the graphic visuals that you're seeing on your screen. TAM is essentially total addressable market. So for the anti-financial crime segment, there is about an $18 billion industry, of which NASDAQ sees themselves gaining $7.6 billion of that $18 billion eventually, and so forth and so forth. Their finances and balance sheet just look amazing. The only call out is their debt is a little big, but they are aggressively tackling it. So if you look at their growth, quarter over quarter, things are looking great. The slowest growing of their business segment is the market platform. You're seeing a very tiny growth, if at all. And then their capital access platforms is also the same story. It's a very slow growth rate, which is why I think they're making such acquisitions, such as the anti-financial crime startup. That startup diversified their business portfolio, and it's seeing a 21% year over year revenue growth. Just like when you consider Microsoft and Google, I feel like the biggest buzzword is now their cloud business segment. Is it growing, and is it still double-digit growth? Likewise, I think for NASDAQ, by diversifying their portfolio to include an anti-financial crime asset, I think it's going to be very good for their bottom line. I think in the short term, there was a sell-off because investors were worried about how successful it could be and the debt they had to take on to pay for it. But I think in the long term, it'll pay off. Now, I'm going to leave this part of the slide up on the screen because this is really important. NASDAQ is a company that is taking care of its shareholders because they know that the shareholders are the true owners of the company. So back in September, the board of directors actually approved $2 billion worth of share buybacks alongside with the consistent dividends. I know 1.81% doesn't sound amazing, but realize that the stock price is going to grow alongside with the growing dividend payout. So far, so good. Next, we are going to be taking a deeper look at the technical indicators and do an analysis on the stock price movement. And I promise your patience is going to be rewarded, because soon, right after we do this, we're going to be running some valuation models to figure out the intrinsic value of the stock. So there are a few things that I am looking at here. First is the stock trading pattern. Is it trading upwards? Is it trading downwards? Is there a line of support, a line of resistance? And most importantly, what is the current relative strength index? Traditionally, a RSI above 70 means that the stock is overbought. Below 30 means the stock has been oversold and it might be a good time to buy. How I always reference the RSI is be greedy when others are fearful, and be fearful when others are greedy. So let's go ahead and take a look. So I zoomed it out to a 5-year view to look at what is going on with NDAQ. So it looks like prior to the pandemic, Nasdaq was trading at a roughly about a 60 RSI, which is slightly above average. Average is around 50 for a normal, healthy stock. And then when the pandemic hit, the sell-off, my goodness, it went from an roughly 80 RSI all the way down to about a 30 RSI, meaning that it was really sold off because of all the fear and the uncertainty of the future during the pandemic back in 2020. And then as we realized with the low interest rates, everybody was going a little ham in the stock market and with all things investing, with real estate and everything, the RSI actually jumped all the way back up to about an 83-ish. And then once we realized that inflation was going to be a really big problem, the sell-off started to happen again. And then it's been roughly trading here and there at about a 30 to a 60 RSI, roughly 45. As of today, the current RSI is sitting at about a 41, but there does seem to be a line of support. If you do 2 years and take a look at this, every single time that the stock price hits the lower Bollinger Band, it bounces right back up and then hits that line of resistance. So it's almost a very predictable and consistent in its trading pattern. But, this is all very speculative. I don't really hold too much weight to the technical indicators as much as I do to the balance sheet and the ratios and the valuation models we are going to run. This is just good to see as a sanity check, but also to see whether or not it's being overbought or oversold right now. All right, time to run some valuation models, and then we are going to compare what we conclude with what Wall Street analysts predict the price target to be. So the first valuation model that we are going to do is the multiples valuation. I selected 5 companies in the same or similar industry to compare Nasdaq to. So I picked S&P Global, Fair Isaac Corp, Moody's Corp, ADP, and MSCI. These are all related somehow or some way with Nasdaq, whether it's in regards to the stock market exchange or it's a data-driven company in the business of analytics, such as ADP. All right, so the median PE ratio for these stocks is sitting at about a 39.3. The average is a 40. So with that, we reach a multiples valuation for Nasdaq of $87.76. Now, if you remember, Nasdaq is trading at a 21 PE ratio, whereas these companies, just look at the PE ratios. My goodness gracious. So the next one we are going to do is the discount cash flow analysis model. Essentially, we are looking at the free cash flow and the growth year over year and determining a share price based on its free cash flow growth. So for the past 6 years, the average growth rate of their free cash flow has been 18.74%. However, the analysts are a little more bearish, and their prediction for the next 5 years has a growth rate projection of 4.13. And you know what? I could meet them in the middle and go with something like a 10 or 12%. But I am going to play it conservative and play it safe. So I'm going to be using the analyst's projection of a 4.1%, even though the data tells us otherwise. So by taking into consideration the very conservative growth rate and plugging in some numbers from the balance sheet, we reach a discount cash flow share price of $50.06 per share. Nasdaq for $50. I think right now it's trading at about 48. Now, mind you, if I do increase this to about a 12% or even 10%, realistically, it is going to reach a share price of $70.66. However, I'm just going to go with the analysts and say 4% to play it safe. The next valuation model that we are going to run through is the dividend discount model. This is essentially going to predict a future share price based on the dividend payout and then the growth rate of it. So by taking the quarterly dividend payout, I mean, this is not a high yield stock, right? This is rather a company that's paying a very healthy, sustainable dividend. It's not sitting at an 8% or 9%. It's roughly at about a little less than 2%. So the average dividend growth rate for the past 5 years has been sitting at about an 8%. That is what the data tells us. For the past 2 years or so, they have been growing it at a double-digit rate. However, I do want to be safe, play conservative, so I am going to plug a dividend growth rate of 6.75%. I could put that 8%, but I'm not going to. I'm going to be a little safe. This gives us an intrinsic value from the DDM model for Nasdaq of $68.32. $68.32 based on its dividend. Now, the next one is going to be a shocker because I always call it the bearish valuation model. It's going to be the Benjamin Graham's valuation model. Benjamin Graham is Warren Buffett's mentor and role model, and he devised this formula that predicts a stock's future intrinsic share price based on its growth rate and the current AAA corporate bonds yield rate. Now, I did go ahead and go conservative, and I plugged in that analyst's 4.13% growth rate projection. And the bond yield rate right now is actually pretty high because the federal funds rate is high. And, inflation right now is really high. However, historically, the AAA corporate bonds yield rate is at about 3%. So based on what we have right now in the current present tense, this gives us a Graham's valuation intrinsic value for Nasdaq, $19.64 per share. That is really bad. But let's go ahead and see what it would look like when things go back to normal, just for fun. Oh my goodness, that is still pretty low, $36.40. I am going to go ahead and use the data of what it is today. All right, so here is the conclusion. If I had $500, would I buy Nasdaq stock? Okay, is it going to be a delicious dividend determination? Or will it be disgusting? Nasdaq, the company, has 4 segments of their business, but they're trying to consolidate the arms of their business into 3 different pillars. Number 1 is the fintech arm, which takes care of the capital markets, cybersecurity, and marketplace technology. And I think right now their focus and emphasis is on the anti-crime division. And then number 2 is their market services. This is everything that's going to be related to the stock exchange and obviously any index that represents the top 100 in their NASDAQ ranking system. And then, of course, all the different stocks that trade on the NASDAQ stock market exchange. This is a toll booth cash flow generating machine, remember? And then number 3 is their capital access platforms. Takes care of data analytics and insights. So jumping back over to the final intrinsic value of NASDAQ. So the Graham's valuation, as we just saw, at about $19.64 per share. And oh my gosh, right now I just burped and I am getting the hiccups, so excuse me. The multiples valuation seems a little optimistic, $87.76, based on similar companies in the same industry as NASDAQ. The discounted cash flow said, hey, NASDAQ is $50. And then the DDM model said NASDAQ is $68.32. This gives us, drumroll please, an intrinsic value of $56.45 for Nasdaq. However, let's see what Wall Street and their analysts have to say about their prediction. Remember, they're pretty bearish because their average prediction growth rate for Nasdaq is 4.1% for the next 5 years or so. So the analysts actually give Nasdaq a price target of $61.09, which as of right now, Nasdaq NDAQ is trading at about $48.71, which is a 25% upside to meet the average forecast. The low target is $49, the high is $82. So let's jump right back on over here. Wall Street says $61. We said $56. And in the end, it looks like Wall Street is more optimistic than I am. I mean, I like the stock and I like the company from what we have seen so far. So let's go ahead and take a look at what should be the margin of safety if we do decide to jump into Nasdaq. So the current trading price for Nasdaq, I put down $48. Sometimes it jumps up to 51, sometimes it goes down to 47, but for simplicity's sakes, we're going to go with $48. Now, whenever I look at a stock, I try not to overpay for it. So my most minimum margin of safety is always going to be sitting at 10%. Now, at a 10% margin of safety, you are looking to jump into Nasdaq when it reaches $50.80. And as of right now, it looks like it's below that, right? So if you are looking to jump into Nasdaq with a 10% margin of safety, it is undervalued right now. But let's see what is the margin of safety if you buy Nasdaq at its current trading price. I'm going to go ahead and assume it's like 13%. Nope, you get more, maybe 15%. Okay, so roughly 15%. If you buy Nasdaq at its current trading price, you are looking to get a 15% margin of safety. So anyways, let's think about this. If I had $500, would I buy Nasdaq? I think based on the data and the finances and the valuation models that we saw today from running through these together, I think Nasdaq is underrated and undervalued. I think it's not on the radar of most people. And on the flip side, the concerning thing is the main segments of their business and their brand, which is the market services and their platforms. I mean, it's only seeing a very low single digit growth rate. And optimistically, they did acquire some startups to diversify their business portfolio, the anti-crime division, cybersecurity, which is seeing double-digit growth. So I think it kind of balances it out. I can't think of too many headwinds coming their way. So with that said, I think if I had $500, when it comes to NASDAQ, I think I'm going to be dollar cost averaging because from what I see, I like it. I like what I see. I think I like this company. I would like to become an owner of this company. And when I decide to buy into a company, my mentality is kind of like this. I don't just think of it as buying a stock and hoping that it goes up. I look at all of these different variables and metrics to believe that I'm buying into the company, a business that has real operations, and I'm becoming a part owner of it. And the CEO and the executive team and the middle management and everyone else in the company, I'm trusting them to run the company well and to execute the operations in a way that is good. But because I really like dividends, their 1.81% yield is pretty low, but it does look pretty healthy and sustainable. So there you have it, some pros and some cons. And at the end of the day, please do your own research and due diligence to determine whether or not you think NASDAQ is a delicious dividend paying stock. And I hope to talk to you next time. This has been Dividend Compounders with Cheese. Stay safe. See ya.